Hey everybody, I'm expecting a big crowd today. We're talking interest rates and financing. That's the buzzword of the month, I feel like. I'm Leah College, an investment counselor here at Real Wealth. Thanks so much for joining us for our live Thursday webinar. I'm joined today by one of my go-to experts, personally and professionally, in the lending space, Miss Caeli Ridge from Ridge Lending Group. Hey, Caeli.
Hey everybody, hi Leah.
Good to see you again. I'm not supposed to have favorites, but I do, Caeli. I've worked with you on many of my personal loans, and painted myself into corners on properties before, and your team has really come in and helped me unsort my mess and get deals closed. So I'm just really grateful personally for your expertise. But I send Real Wealth clients to you all the time, because you have a lot of dexterity of loan product, not just extensive experience in the space, but you have the conventional loan product, those Fannie Freddie loans, but that you also have a huge repertoire of non-conventional loans and ARM loans and interest only and the all-in-one, some of which we're going to chat about today. So I love that people can kind of come to you for a one-stop shop.
I'm good with all of that, Leah. Yes, yes, and yes. I'm looking forward to peeling back in some of the details for the listeners today. Thank you for that.
Yeah, so we're really grateful to have you on today. We're going to talk about how you can use leverage effectively in spite of today's rising interest rates. This is the topic that's on everybody's mind lately, so very timely to have you on today to share your expertise. Before we jump into today's content, I wanted to highlight an awesome podcast that our founder, Kathy Fettke, did just last week. She interviewed Hunter Thompson of ASYM Capital, and it's a fantastic interview. It is so timely, addressing a lot of people's concerns about whether or not this is the right time to be investing property or to be investing in investment property. Spoiler alert, Hunter says he thinks this is the greatest opportunity maybe ever for investors in real estate. He thinks 2022 is going to be extremely bullish, or he is extremely bullish on 2022. So I wanted to highlight this replay. It's posted where you can find our podcast on any podcast player. You can find it there directly from realwealth.com. If you're logged into the portal, go to education and you'll see a podcast replay section there to watch episode 884. If you're curious about whether this is the right time, this is definitely a podcast that I think would go really well with the conversation that Caeli and I have planned for today. So check it out. Our standard disclaimers. So the things we're going to talk about today might not be appropriate for everyone. There are other options that we won't discuss that might be more suitable for your specific situation. So as always, you want to consult your own team of experts, accountants, tax advisors, attorneys, to discuss your specific situation, understand what's right for you. Past performance is no guarantee of future results. Despite Caeli's extreme experience in this space, she doesn't know the future. Real estate purchases are, of course, subject to investment risks, including the possible loss of amounts invested. So we're going to make sure, or we're making every effort to make sure we're giving you accurate information today. Know that some of what we're going to be talking about is our opinions, and there is definitely the possibility of errors and or updates in the future.
Good one.
Okay, Caeli, you're a familiar face to many of us around here, but for those of you who don't know Caeli Ridge, tell us a little bit about yourself and your business.
Sure. Hi everybody. Thank you for spending your lunch hour with us. I think that your being here kind of separates you from the rest in making sure that you're prepared and have your finger on the pulse. That's what we're here to kind of help inform you with. So for those of you that are not familiar with my name, Ridge Lending Group, we are a multi-generational company that focuses not exclusively, but largely on the individual real estate investor and largely on residential real estate, while we still look at commercial and we do all of that work. A lot of what we are working on is residential, that is single family up to 4 units. We are licensed all over the United States. There's only 4 states currently that we are not licensed in, or we're not funding loans in. Those are Alaska, North Dakota, New York, and Vermont. Otherwise, we're everywhere. So I always say we have a nice broad footprint for investors because most are not focused on just one particular market. And if they are, they really shouldn't be. We'll get to that later. I think that as the value adds for us as a company, what we really strive for is the education of real estate investors from an underwriting and lending perspective. I think most of you here will probably agree that the learning curve in real estate investing just on its own merit is extremely intensive. And I'm always quoted as saying when I do these webinars and podcasts, when you start to layer in the financing or the new language of finance into that learning curve, it exponentially increases it. For a lot of people that I work with and I talk to, especially new investors, they share with me it's the financing that they feel most overwhelmed by or intimidated by. But without it, guys, without the leverage or use of other people's money, what happens to our ROI? It's not going to be as great. So I think it's kind of a foregone conclusion that you really want to have a look under the hood. You want to be working with a lender that understands from an investor's perspective, which, by the way, I think I failed to mention, I'm a real estate investor. I've held 42 properties at any one time across the United States, so I do have a particular perspective here, and Ridge is very uniquely qualified to help guide our real estate investors from that underwriting perspective and giving you guys the education and the definitions that aren't readily available out there. It's not dear Google stuff, right? So, and it's changing constantly. It's a moving target. So having a money source that really understands from your own perspective and can teach you what's going on behind the scenes in underwriting, and then further how to optimize all that stuff, right? What is debt to income ratio? How is it calculated? How does it apply to a Schedule E and real estate income, credit score optimizations or asset optimizations? Those are the things that we hold great value in imparting to our clients. So of all the other value adds, I'm just talking to hear myself talk now. I think that the education that we provide our clients and the very diverse product line that you mentioned, Leah, we're not a one size fits all, is probably what we're really synonymous with.
Yeah, I agree. I try to emphasize to people all the time in calls, a lot of people come to us maybe with a pre-approval from a local big bank lender, who maybe has no real expertise in doing non-owner occupied loans or investment loans. And I have to, maybe even too much so, convince people that there is a benefit to working with someone who can think beyond just one closing, one trade. If you're an investor and you only own one deal, it's like one transaction. Okay, you can probably get by with any old lender. But if you aspire to do something powerful with real estate and meaningful, something that impacts your future life, working with a lender who gets the bigger picture of to get to and who can educate you on, the factors or the data points of your own borrowing profile that matter, you can just be so much more strategic about growing your portfolio. So I appreciate that.
Yeah, absolutely. I think you hit it right on the head. Transactional, right? Big boy banks maybe, which is fine, versus holistic, where we're really looking at helping you plant seeds and prepare roadmaps for your future success. Totally agree. Okay, so I think we've got some really good content for you guys today. I'm very excited to share some of what's happening, what's new, what's coming. I think that there's some good content here. So if you want to skip to the next slide for me, Leah, I'm going to go off camera because I've got some notes and I don't want you to distract you guys with me looking over here at my notes. So if you go to the next slide, I'll get right into it. This is top of mind, right? Is the sky falling? Is real estate doomed for us real estate investors? I think, gang, depending on, here's my 1.3 cents worth, okay, just related to what is happening right now. Depending on the news feed that you guys will most subscribe to, whatever that is, I think that'll answer our question. I'm here to confirm from the front lines, and as a fellow real estate investor, as I mentioned, with many years experience, having survived 2 full real estate cycles now, and let's be real, like any investment, this is cyclical, and I think nothing is more true than related to real estate. Real estate is extremely cyclical. I've survived 2 full ones. I'm going into my third now. No, we are absolutely not doomed. And further, I can say to you here without hesitation, I am extremely bullish on real estate. I think the important thing to comment quickly without getting super political is, whether the world as we know it today as real estate investors is ending or not, is accessing information from a diverse and multiple outlets, okay? If you're not doing this, you're being fed an agenda. And almost certainly with it's politically founded, right? That's what's being given to you or provided to you, and they're selling something. I would suggest this: be well informed. Okay, do your own due diligence. Don't allow your preferred newsfeed to spoon feed you their version. If you're only ever watching one source, I'm just going to pick on the big names, right? If you're only ever watching CNN or you're only ever watching Fox News, for example, you're going to have a very clear predilection toward one or the other as it applies to real estate or interest rates or whatever it's going to be. Okay, so please do yourselves a favor, get data, gather information from multiple sources, diverse sources, and make sure that you are coming up with your own conclusions. I think that that's super, super important. Okay, that's all I'm going to say about that. Here's the facts as I see them today. The Fed's primary concern, or one of their primary concerns right now, is going to be housing. And the Fed is going to continue to push interest rates up until housing values soften, they come back down. But guys, this is not a bad thing. We need rising interest rates to level things back out a little bit. A 30% appreciation rate of housing is not healthy and it is not sustainable. And if it's left unchecked, we know what happens, right? We've got housing bubbles. We're going to have collapses. Nobody wants that. I think anybody that has any kind of common sense probably intuited this over the last couple of years, that the appreciation that we've been seeing cannot just continue unchecked. So how will the Feds circumvent this? How are they going to help us through this? Well, obviously by raising interest rates, of course, but what does that mean specifically for us? So first of all, it means that we're not going to be bidding against 20 other buyers and coming up empty-handed 9 times out of 10, right? Everybody would probably here today experience that in some way or some fashion over the last couple of years, right? You put an offer on a property and you've got 10, 20 other investors or homeowners trying to get the same property, and chances are with that kind of competition, you weren't successful in making the offer or getting the offer accepted. I think that ultimately what this means for us, it's going to take this staunch seller's market that we've been living through over the last couple of years, and it's about to shift. I see the writing on the wall. The tide is turning. It means that we as investors are going to have more opportunities to A, negotiate the price points, the purchase prices. Hello, it's about time. And it's also going to mean things like seller paid closing costs are going to come back, right? We'll be able to negotiate the seller to contribute towards our closing costs so that we can stretch our capital a little bit further. So when I go into this conversation with my clients, the next question people say, well, but Caeli, what about interest rates? They're up. Yes, they're up. So what? So what? Now listen, you guys, I don't want to be too harsh or off-putting to anybody here, okay? But if you're only focused on the number that the interest rate represents, I might just lightly challenge you to rethink your entire investment philosophy, okay? I'm going to come back to rates in just a bit, right? We're going to spend a lot of time talking about interest rates, but let's kind of go through some of these bullet points. Qualifications, right? If we believe that the coming 12 months, 24 months is going to be prime for real estate investing, these are some of the things that you should be asking yourself if you haven't already. So qualifications, are you qualified? When is the last time you had a lender look at your debt to income ratio, your credit scores, your assets? Do you know where you stand from an underwriting perspective in order to utilize that leverage, right? That other people's money thing. If you haven't done that, do it. Call us right now and we will get you through the gauntlet of pre-qual and make sure we get you that baseline. We'll give you the definitions and tell you what comes next, okay? Next, are you sitting on equity in any of your properties? Primary residence, non-owner occupied, second home? Are you just sitting on it, just waiting for rates to come down? Okay, I think I'm going to have an alternative version for you here throughout this conversation today. If you are, I'm going to say more often than not, 80% of you are, I'm going to say you probably primed to refinance, regardless of the interest rate. And then finally, in taking advantage of what's to come, do you know where you want to invest? What market are you going to be in? Do you have a turnkey property that Real Wealth promotes, right? There's, I don't know, at least a dozen, probably more different turnkey partners within the Real Wealth network that you want to be contacting. Do they have inventory in the market that you want to be in? So those are some of the things that if you haven't started asking yourself, you really want to. Next slide, please.
Caeli, are you suggesting or kind of advising that people like are take a pause right now and wait for this market to kind of soften, or are you telling people, hey, drive on as usual, just know deals will get even more lucrative potentially going forward?
I am always going to say move now. Do not sit on the sidelines and wait for the best this or the most optimal that. Right now, I think we're in actually a very good place. And if for nothing else, get ready right now. Don't wait 30 days or 60 days or 90 days or 6 months to say, okay, now I want to look at real estate investing. What you should be doing is preparing today for what's coming tomorrow, because I promise you guys, we are right on the precipice. We're there, right?
Yeah.
We're at the end of June. We're almost in July. You are going to find yourself in a place where real estate is going to be more affordable, even if interest rates are higher. I will get into this, than it has been in a long time. So now is your opportunity. Don't wait.
Yeah, I love that. I don't want to jump the gun with a question here, but this was specifically one that I had written down that I wanted to kind of chat with you about because, myself, you're talking to me with bullet point number 2 there, in kind of priming yourself to utilize the equity that you have. There's a lot of investors that I talk to, every day who have been buying over the last several years, and they've seen that 30% appreciation in some of their assets in just a year's time. And so they are sitting on homes that have great equity, and because rents have also gone up, they're cash flowing great too. And I feel myself in this tension of like, it feels really nice to have like equity that's yours, but also it feels really nice to have great healthy cash flow too. But I feel the little voice in the back of my head, maybe named Caeli Ridge, saying like there's dead money there that could probably be working harder, and these high interest rates should be the last thought that you're considering when you've got that much debt equity sitting there. How are you coaching people through that analysis?
So when we get to the next slide, we're really going to dig into this. It's all about doing the math, you guys, and it's all about a holistic approach, which is kind of what I started the theme of how I started this conversation. If you're just focused on an interest rate and debt equity that's sitting in your property, now if you're on phase 3 of your real estate adventure, right? You're 65 plus maybe, and you're ready to retire, and you don't know that you're really going to take your investment to the next level, then maybe this doesn't apply to you. But don't just assume what an interest rate or where you think values of properties are going to go. Don't make assumptions. I want you to do the math. Okay, so let's just talk about my first bullet here. Do the math. Most people don't do the math. They hear a headline or they read a marketing piece from whatever publication. Rates are going up, whatever it may be. They take that, they internalize it, and then they don't take it to the next step and the next step and the next step. If you're not doing the math, it's extremely short-sighted, and you're going to get left in the dust. Let's peel this back a little bit, okay? So if you haven't done the math, what you want to be asking yourself is, with the rise in interest rates, can you afford a payment of X? AKA, will the tenant's rents cover the payment? Is the answer yes? Then chances are very good the investment makes sense, right? People have short memories. I'm guilty of this myself. And we've become rather spoiled over the last couple of years with what we've seen for these high cash flows at ridiculously low interest rates. The tides are turning. That is to tell you that we have new opportunities, irregardless of where interest rates are today, that we should be taking advantage of. Cyclical, right? Let me be specific. If a refinance does create a negative cash flow, let's say, for example, you're at 3% right now. I get this all the time. You're at 3% today. Why would I exchange that for a 6% interest rate? Why wouldn't you, is my question. Do you want to invest in real estate? Yes, they answer. Well, the next couple of years might be the best time in which to do that, and it's probably going to be the best time that we've seen in a long time. Why? Because I believe home prices are going to be falling, and they're going to continue to drop. Now, am I saying that they're going to drop through the floor? Anybody that's been around long enough, 2008, 2009, that is not what I'm talking about. But real estate and home prices are going to come down a little bit. So if you're taking a 3% rate and refinancing into a 6% rate, what does that mean, right? Does the rent still cover the mortgage payment? Yes, great. Does it not? Okay. By how much? Are we negative 10 bucks a month, 20 bucks a month, 30 bucks a month, $100 a month, whatever that number is, you have to do the math. Will the cash out, borrowed funds are non-taxable, remember that, will the cash out of the transaction yield a return enough to cover or cover plus 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 whatever we're giving up in the cash flow over here? If it's yes, you guys, I'm going to encourage you to take the cash. There's 5 or 6 more elements within this discussion that you should be looking at that include annual appreciation of rents, not necessarily property values, but of rents. You should be appreciating those. I think I've got another slide that goes into that. Tax deductions. Here's kind of a silly example. What happens when interest rates that we're paying on investment properties go up to our Schedule E? This isn't a trick question. The taxable interest, mortgage interest that we can claim is also going to be higher. Now, while it's not going to be dollar for dollar, you have to include that when you're doing the math. What you're giving up here by doing a cash out refinance and taking a 3% interest rate, and I'm just making up numbers, and trading it for a 6% interest rate, but I'm harvesting 50, 60, 70, $100,000 worth of equity that's going to translate into this return. The other pieces that you have to consider are, I'm going to continue to appreciate my annual rates, right? And my Schedule E and my tax benefit is also going to improve. So you have to be checking all of those different boxes, okay?
Yeah.
Did you have any questions, Leah?
Yeah, I mean, the means by which to access it. When you mention that, are you referring only to a cash out refinance, or are there any other ways that you can tap into some of the equity?
Absolutely. So if the math, right, once you've done the math, if it doesn't make sense for a full cash out refinance based on your particular criteria, maybe we look at a second lien, right? Second lien HELOC, home equity line of credit. Maybe we look at a first lien HELOC in the form of an all-in-one. You just have to do the numbers. You've got to crunch the math and look at it from that holistic perspective. But let me go back just a step here. If we know that home prices are going to come down a little bit, we're going to take the equity out and be ready to strike when the time comes. Again, who cares about the rate? In a couple of years, you'll be able to refinance anyway. In a couple of years, will the rates be back down to 3%? I don't know, probably not. I hope not, because that would mean something else has derailed us, right? That means that some other travesty has come about that's driven our economy into the ground, and we have to keep them down that low. But you'll be able to refinance at a lower rate than you'll get now in a couple of years. And what have you been doing in the meantime? You've been appreciating your rents, right? Or you should be. So like I said, if the numbers don't work by doing just a full cash out refinance, we want to look at a second lien HELOC, harvesting equity that way. Again, make sure to do the math. I cannot stress this enough. But whatever you do, please don't assume that because you have a super low interest rate now and you've been quoted a higher interest rate as a result, that a refinance is an automatic stopping point, right? That's scarcity mentality, gang. And I promise you, it's not going to serve you when you should be preparing to take advantage of this next market cycle.
Yeah, the analogy I always think of, or what I always picture in my mind, is the person with like an armful of dimes, and they're trying to hold all the dimes, and they're just walking past all these quarters, trying to hold on to the dimes. It's not wanting to hold tight too hard to what you have, such that it causes you to miss the opportunity that it could give you.
I love that you said that. So one of the analogies I'm constantly using, do not trip over dollars to pick up nickels. Right? And I see that all the time myself. They're tripping over tangible investment benefit to pick up, pennies and nickels. So the math is going to be super, super important. One other conversation that I have that might be noteworthy is that when I'm sitting here talking about pricing, I believe housing prices are going to come down. They're going to say, well, what if I buy now and values go down 10 or 20 or 30%? Why would I do that? Well, then I've got to ask the questions, how long do you plan to hold the property? Is it 5 years? Is it 10 years? Does it cash flow now? Is there a strong tenant market in the area that you're purchasing or that you're wanting to refinance? If you've got yeses to those answers, then who cares? My point is, you cannot take any, you can't take the information and make any kind of financial decision because you're following a headline without looking at the big picture from your lens. Okay, I'll shut up now about doing the math, but really it's subjective to the individual and the individual's properties. Don't make those assumptions. Before we move on, I want to take a second and quickly touch on the recession topic. This is another conversation I have all the time. My personal view is not if, but when we get there. As it relates to interest rates, the Federal Reserve arsenal to fix the situation with where rates are now is going to be to pull back rates. The reason for this is they've been so violent and so aggressive on the way up, right? So from late December to now, you guys have probably seen that ridiculous trajectory. They've been extremely aggressive on the increase of interest rates, and that's largely because they've been sitting on their hands for the last 2 years, exclusively because of the pandemic, right? I mean, they didn't have a ton of extra options. But I would expect in the next 9 months, 12 months, maybe it's 18. That crystal ball that you talked about, Leah, mine's broken more often than I want to admit, but I would expect that between the next 9 and 18 months, we will see a pullback in interest rates. But in the meantime, what are we going to do we're going to sit around on the sidelines and not invest because rates are up while housing prices are finally coming back down? That's not what I'm going to be doing. I'll leave that alone. Let's move on to the next slide.
I always want to point out to people, like, there is no catalyst, and we were saying this all along while interest rates were as low as they are, but like there is no catalyst to collapse at this point. You know, borrowers are very well qualified for the loans that they're in. People are in great equity positions. There is no, well, there's less distressed sales happening. People aren't in distress like they maybe were in the last housing crash. We still have the demographics that we were banging that demographic drum, I feel like, all last year. Like, this is why home prices are skyrocketing. In addition to interest rates being very low, we just had a huge group of people that all need housing and are entering prime household formation. Those didn't just suddenly evaporate or disappear now that rates are going up a little bit. Some of them are going to turn from buyers to renters, so that helps those of us who are already investing in rental property. But there's still this need for housing, and we are severely supplied. So I do think there'll be less competition, but I mean, we just got to remind ourselves, like, I think we're still in a pretty optimistic position, you know, especially long term, for these investments to do powerful things for us.
I totally agree, and maybe it's cause for another webinar. But if we want to, if anyone's trying to compare today or what's happening now with 08, 09, they couldn't be more uninformed.
Mm-hmm.
The connections between the two have nothing to do with one another. And as far as I'm concerned, in our lifetimes, we will never see another repeat of both housing and lending at the same exact time imploding on each other. That's not going to happen.
Right. But it was really traumatic for all of us, so it makes for great headlines today. Like, it's clickable, you know, so that there's no surprise that they're trying to draw lines to what happened previously.
100%. And in fairness, I survived it, so I still have some PTSD from 08, 09, right? But this could not be a 180. It could not be more different cycle than what we've come up to now and what we're going into. Could not be more different. There is no comparison. Okay, so rates versus rents, another thing that I talk about all the time. Let's quickly just touch on, how often are you guys increasing your rents? Have you talked to your property management about this? And if you haven't, you probably need to. I'm always telling my clients that you want to be appreciating rents by a very modest, and I think going into the future, it probably should be a little bit more, but average national, modestly 2 to 3% a year at minimum. Those are the minimum numbers that anybody should be appreciating their rents. And then the next bullet there, do rents always go up when, well, that should say when rates do. The answer is yes. Historically, rents will follow suit when rates go up. Unfortunately for us, they don't move at the same speed, right? When rates go up, rents don't automatically follow suit. It takes 3, 6-ish, 9 maybe months, but they will catch up, right? Especially if you are appreciating your rents the way that you're supposed to be. Okay, let's go to the next slide. All right, so here's just, I'm going to very quickly touch on these. These are the different lending options that we have access to for our investors. I started by saying we are not a one-size-fits-all. You can clearly see the diversity of loan programs. All of these are non-owner occupied access, not exclusively in each case, but some. Our golden tickets, everybody knows what that is. That's our Fannie Freddie, highest leverage, lowest interest rate on the planet. However, I think that may be changing. Again, maybe another webinar topic, Fannie Freddie, and as interest rates go up, who knows what's going to happen with the conservatorship that Fannie Freddie has been in since 2008, 2009. But I will tell you that the 30-year fixed model, I'm starting to see some great improvements to alternatively ARMs. I'll get into that in some of the next slides. So we've got our golden tickets. There's 10 of these per qualified individual. Non-QM, qualified mortgage is what that means. For those of you that aren't aware of that, of what that definition is, Fannie Mae and Freddie Mac are the definition of what a qualified mortgage is. Post 0809, Dodd-Frank came up with a sweeping legislation that created qualified mortgages. Everything outside of that is now non-QM. And non-QM is not just for investors. It's for anybody that cannot fit inside the Fannie, Freddie, or FHA or VA box, okay? Next, we've got debt service coverage ratio, or DSCR. This is a way of, similar to a commercial underwrite, all we're looking at is the property's performance, the gross rents divided by the proposed PITI. For you newbies, PITI is principal, interest, taxes, and insurance. It would include HOA, homeowners association dues if it was applicable. Very, very simple. I'm going to give you guys the formula there. If your gross rents were $1,000 a month and your proposed PITI was $1,000 a month, your debt service coverage ratio is 1.0. Okay, that's the easy math there. The next is the all-in-one, and I can do deep dives on any of this, Leah, as we get through.
I have a question real quick on the DSCR. Can you do a refinance into a DSCR?
Absolutely. Yep, refi, cash out, rate and term purchase, whatever the circumstances are.
Okay.
Yeah. AIO, all-in-one. This is a first lien HELOC, extremely popular with investors. In fact, I don't know that there's a better vehicle or tool for the right individual as an investor than the all-in-one. We can talk more about that if you want to. And then finally, commercial products that can apply to residential properties in a cross-collateralization way, where you would take one loan and blanket 5 single-family residents, for example. That can be in a commercial product as well. Yeah, any questions about that you want to quickly touch on?
Well, I'll highlight for the viewers that we did an extended all-in-one, we did a webinar on the all-in-one loan product, I think the last time that we had you on, where you pull up like the calculator that lets you kind of analyze whether this loan product would be beneficial for you or not. And that replay is on your information page. So again, if you're logged into the Realty portal, realty.realwealth.com, and you hover over resources, you'll see Ridge Lending Group is listed under conventional and non-conventional lenders, since she does both. And when you click on Caeli's page, you'll see there's an education tab, and we archive all of the webinars that we've done with Caeli there. So the most recent one was all about the all-in-one loan product. So to save that conversation, maybe the deep dive for a replay would be, I think, good for the interest of time, because it is an amazing loan product and a challenging one to understand, frankly.
You're right. I'm glad you brought that up, because I'll tell you guys, I flatter myself as understanding finance pretty well. When the all-in-one was brought to my attention for the first time, I had to look at that dang thing for a couple of weeks before I could really grasp the concepts and what it was trying to do. Anyway, I love it. I'm a huge fan. Yeah, check out that webinar. And if you have any questions, let us know.
Yeah,
okay.
There's a couple questions here. Tom, while we're on this slide, Tom wants to know, what is the ratio required for a property to qualify for a DSCR?
It can be as low as 0.75. So the example I gave was 1.0, right? The gross rents and the proposed PITI are identical. They're the same. That would be 1.0. So the gross rents could actually be a little bit lower than the proposed PITI, and it would still be a qualifiable loan. Keep in mind that the lower that number is, the higher the rate will be. Optimally, for rate purposes, 1.25 and above generally is what we want to see the debt service ratio be.
Have you noticed that people in the context of today's lending space, the golden tickets, I mean, when I really got going with investing, this was like it. Everyone's like, don't even look at other loan products until you've maxed out your, 10 Fannie Freddies. Are people still saying that today, or are you a little bit more like open to considering other loan products?
That's such a perfect segue into the next slide. If you want to click through, let's talk about that. So the comment to your statement is that when you guys were first setting out, I would have said the exact same thing. There is no incentive to look at anything other than a 30-year fixed because we've been on what's called an inverted yield. So let me just quickly define that for those of you that aren't familiar with that term. This is largely after 0809, right? The crash of 0809. An adjustable rate mortgage prior to that was very mainstream, very prevalent in what we were doing for investors. An inverted yield means that a 30-year fixed rate for the last 10 plus years has been pricing lower than an adjustable rate mortgage or an interest only. Why? That leaves us with zero incentive. Why would you take a 5-year adjustable at 7% when you can get a 30-year fixed at 5%, right? You wouldn't. So that's what we've been living under. As interest rates have continued to rise, the ARMs are coming back in the fold. I'm so excited about this. I am a big fan of adjustable rate mortgages and even interest only. Let me explain, okay? So the truth about adjustable rate mortgages, that a lot of people, I think over the last 10 plus years, have kind of been conditioned to fear them. The truth is that the shelf life of a 30-year fixed, okay, on an owner-occupied basis, and statistically we know that investment properties are turning over faster than a primary residence mortgage would, but the average shelf life for a primary right now is about 7 years, right? That means that from the day that they close on that 30-year fixed to when they're looking to refinance and improve interest rate or pull cash out or sell the property or whatever it is about 7 years. For investment properties, that's closer to 5 years, right? So that's the first thing. The second thing that I would give to the listeners statistically is that the amount of, or the percentage of human beings in the United States that start day one with a 30-year fixed mortgage and make that mortgage payment and end up making 360 mortgage payments later to pay that off is less than 1%. Okay, so there's a psychology about fixed rate mortgages or rates in general, and in particular right now because of what we came out of in 2008, 2009.
Yeah, it feels responsible to do that.
Right. When in fact, in a normal market, not an inverted yield market, which is where we've been, but as we're moving back into a normal market where an adjustable is a half or a full percentage point plus better than a 30-year fixed, there's no reason to take that 30-year fixed because you're just going to end up paying more in interest. The first 10 years of any 30-year fixed mortgage is 99% interest anyway, gang.
Right.
So anyway, I am a big fan of adjustable rate mortgages. I gave you that little bit of information. Are they back? Yes. I mean, literally within days, weeks, we are right on the precipice of seeing, at least for us, access to those ARMs and making them enough of an advantage in lower rates so that it's worthwhile.
Caeli, you're fighting against a sentiment that is very clear. I can recall 2 emails today with investors who were questioning, like, oh, but is it dangerous to do an ARM? What are the risks? I think I even shared with you in an email. I saw some headlines when ARMs first started being kind of talked about a lot, maybe 2 or 3 weeks ago. A headline said, "Bad boy loans are back," and there's this sentiment that these are like dirty loans that are super dangerous and that is going to cause our housing market to collapse once again. So teach us, school us on the ARMs of today. What do those actually mean, and help us quantify the risk of them?
Yeah. So let me start by saying a bad boy loan is not an adjustable rate mortgage. A bad boy loan is probably going to be something more like a neg am, if anybody remembers what something like that was. I won't go into all of that. or qualifying an individual that had no business getting a loan, right? 100% stated income, no asset loan, that's a bad boy loan. An adjustable rate mortgage is a responsible means, especially for investors or even a homeowner that is educated or has educated themselves to understand the reality of mortgage lending. So I would go toe to toe with anybody that called a 5-year ARM a bad boy loan. But let me give you guys the mechanics of this and how an adjustable or an ARM works. And then maybe we can get into the interest only piece. So with any adjustable rate mortgage, there's two primary components, something called a margin and something called an index. A margin is the fixed portion of those two components. This means that for 30 years, which you actually have access to an adjustable rate mortgage for 30 years, I'll explain in a second. But for 30 years, the margin within this ARM will never change. It's fixed. It does not move. The variable part of the mortgage is the index. This is what can go up and down. You add those two components together, the margin and the index, and it creates a fully indexed rate. Additionally, on any adjustable rate mortgage, there are going to be rate caps associated. The caps are going to be 3 different numbers, and they're going to tell you, the first number is going to tell you how much the first rate adjustment, where the rate can increase. The second number is going to tell you how each subsequent rate adjustment, the max it can increase. And then the third number is going to tell you what the life cap is, the maximum ever the rate can adjust for. I'm big on trying to set examples. I think it helps with people's retention. So let's just take the most common for investors, a 5-year ARM. And I'm going to talk about a 5-1 ARM. That 1 after the 5 indicates that after the 5-year fixed rate period, the interest rate can adjust a maximum of 1 time per year. There are other ARMs, for example, would be a 5-6. That would be after the 5-year fixed period that the rate can adjust every 6 months, or AKA twice a year. Most common, we find 5-1 ARMs, fixed for 5 years. After that period, the rate can adjust 1 time maximum per year, and the caps for a 5-year are commonly, not always, but typically you're going to see something like 225. Okay, those are the 3 numbers. So let me go over that again. The first, and let's say that in your 5-year ARM, you started at an interest rate of 6%. Okay, I'm just throwing numbers out there. The first rate adjustment in month 1 of year 6, if the index had climbed enough, the maximum that the rate could move starting at 6 would be 2% over that. So it could not go more than 8% in that first adjustment. Because remember, my 3 numbers are 225. So the first rate cap cannot exceed 2% over the original rate that you started with. If we started with 6 and the index was applicable, it could not go more than 8 in that first rate adjustment. The second number is 2. That says that every subsequent rate adjustment, if you just let this thing ride, could not also go more than 2% at a time, with a life cap of 5. So if you started at 6, no matter what happens with that index, your rate could never exceed 11, 5% over the 6. How did I do? Does that clear as mud, right?
No, I think it's good. I'm following your examples. So are most people, or are you recommending that people focus on the 5-year ARMs or the 10-year if it makes them nervous? I mean, where are you kind of guiding people to with those options?
I think that it's subjective to their individual goals. I think 5 years is probably the most common because more often than not, again, statistically, we know that people, investors particularly, are refinancing, harvesting their equity, borrowed funds are non-taxable, or they're doing a 1031 exchange or whatever. If the individual knows that it's going to be longer than 5 years, then yeah, we'll look at a 7-year. Or if they just can't get over the fact that you know, the adjustable and they just want extra comfort, fine, we look at a 10-year. Amortized over 30 years is what these loans are. There are interest only, we'll come to that in a second, but I think it's subjective to the individual property and the individual's goals and their needs and their level of comfort or risk aversion.
How much savings is it actually buying you, Caeli? I mean, are you seeing significant differences in the rate between those 3 when compared to the 30-year fixed?
We're starting.
Is it?
Yeah,
Go ahead.
we're starting to. So I would say that for me, I'm probably not going to consider an adjustable rate mortgage unless unless it's posting a good 0.5% better than a fixed. Ideally,
Okay.
we want it to see a full percentage point, right? That's the ideal, or even more if you can. So I guess that's a benchmark. If I were to give one, that would be the
Yeah.
baseline that I would use when they're looking at it. Now let's
Yeah.
take it and a step further and talk about interest only. Okay. Similarly, these are going to be on ARMs. I'm going to keep using my 5%, or excuse me, my 5-year 5-year fixed scenario, and let's put an interest only on there. Let's talk about the difference between interest only and amortized. And remember, the first 10 years of a 30-year fixed mortgage, vast majority of your payment is going straight to interest. You do not start even plunking anything toward the principal really until the back end of the loan, year 11, year 15, right? It's largely interest because, I mean, the 30-year amortization is fantastic for our cash flow, right? But if you keep that loan for 30 years, you're going to be paying twice the principal that you borrowed in interest, right? That's what you're paying for the benefit of getting that long term and that extra cash flow. Now, if we know that we're going to be, as investors, updating our mortgages and pulling cash out and refinancing, interest only, I think, is a fantastic way to increase the cash flow. So as an example that I wrote down before our start of this, if we take, I'm just going to use 150,000 as our loan size, okay, and I've used 6.75 as an interest rate. Principal and interest, given that scenario, is $973 a month. Interest only is $843. Okay, so there's $130 of realized cash flow immediately on this transaction. Take the cash flow, right? Stockpile it, do whatever it is that you were going to do with it anyway, and then you're refinancing in 5 years or 7 years or 10 years or whatever it is. It really allows us to have that extra flexibility now that we're seeing interest rates rise the way that they are. This is the way investors need to start retraining themselves to think. This is the way it's always been done in real estate investing. Don't take the last 10 years and assume that that's the only way to do it, because it isn't. In fact, that's very subjective to that place and time. It's never been the way investors have looked at real estate.
Yeah. I want to clue everybody into the conversations that I get to be a part of with our property teams, with lenders, with people who have been investing at scale over a long period of time. Really, it's within the last 3 weeks, Caeli, I feel like everybody is really diving into these interest-only loans and the ARM product. Like, this is how investors are still able to make the numbers work and underwrite their cash flow, you know, in a way that doesn't have them feeling like they're over speculating on opportunity. So I want everybody, just because I get to hear these conversations all the time, but you guys don't. Only through these broadcasts, you don't get to hear just how many experienced people are moving into these products. I was on a call with one of our builders last week, and he was securing his own lender partners and moving a lot of his own personal portfolio, refinancing into these interest-only loans. With the interest-only, Caeli, what are the mechanics of that? Are you locked in for? Are you paying interest only for a 5-year, 10-year in kind of the same way, and then it goes into a 30-year after the fact, or is it really a line in the sand where after that initial term you have to refinance?
So it's not a balloon, which is what that would yield. So more often than not, I'm going to keep using the 5 years. So 5 years interest only. What happens is that in month 1 of the 6th year, it becomes principal and interest, more often than not, and then the principal and interest payment will be amortized over 240 months. Did I get that right? 300 months, 25 years. I can't do mental math. So it's going to be amortized over 25 months based on that fully indexed rate for that point in time. Okay. So you're probably going to be incentivized to want to refinance, but no, you do not have to refinance. And based on where the property is at that point in time and where, you know, market rates are and the rate adjustments I talked about, you may want to let it slide. For those of you that remember what happened with 0809 that had an adjustable rate mortgage, many of you were dancing Dixie, right? Your rates were at 5, 6, 7%, and after the crash, you were paying 3%, right? Because the index has just dropped, and so it depends on the scenario, but it would generally be principal and interest over the remaining
Yeah.
term of the loan. And I'll share one other little piece. So up until recently, Libor, some of you may be familiar with that abbreviation, London Interbank Offered Rate, has been commonly, almost exclusively, the index used for mortgage-related finance. Well, with Brexit, Libor is phasing out. There is no more Libor. We're not using Libor as the index, and there are dozens of indices out there. The one that you're going to start seeing most often here in the US is going to be the SOFR, SOFR, Secured Overnight Financing Rate is what that stands for. I believe that's going to be the benchmark index to adjustable rate mortgages. Currently, for anybody that's interested, the index for SOFR is 1.04.
Mm-hmm. So something in my mind, Caeli, that I've been kind of trying to play through is like the worst case scenario. And Derek asked a question here that made me think of this. He said, well, what if you're upside down on the home, then how are you going to refinance? And I try to like zoom out and think about what's happening in the economy in this scenario. We can't know with certainty, right? But if I think on what generally happens in the economy, if home values are tanking, if I'm upside down on my property, we're probably in a recession. And what is the posture of the powers that be when we're in a recession? Well, they're usually trying to stimulate the economy. And what is one of the strings that they can pull to stimulate the economy? Well, they can lower interest rates. So, and I'm curious to know your thoughts on how you play out kind of the worst case scenario if you had gotten into one of these loans and it comes time to refinance and you are upside down on this property. Walk me through what you think logically would happen.
Well, I think there's so many variables that we could sit and say, well, if this and then if that, but I'm just going to kind of give an average. So if you find yourselves in a place where you got into a 5-year interest-only mortgage, okay, and the value of the property was $100,000 today when you did it, and in 5 years' time, the value of the property is $90,000, right? It went down and it stayed down, which I'm going to tell you is not going to happen. But let's say I'm wrong and I don't know what I'm talking about. Okay, let's say it did happen and you owe more than the value of the home at this point. If that were happening, interest rates have definitely pulled back, and your adjustable rate mortgage that you started with 5 years ago at 6 is probably posting at 3 or 4 if we found ourselves in a space like that. So yeah, you don't have the equity in that house anymore or at that point in time, but you're going to be cash flowing very, very well.
You just hang on.
You hang on.
Right.
Who on this call is here for short term? And maybe we have some fix and flippers, that's fine. But how many people literally do we have here with us today that are short-term real estate investors? This is a long burn. This is not a year or 2 years. I mean, most people hold their properties for 5 and 10 years and continue to harvest their equity. They continue to look at how the markets are doing and they sell it and they do a 1031 exchange and avoid cap gains and buy more properties. So that would be my answer based on that set of variables, knowing that there's unlimited amounts of variables that I could, combat.
Right. Yeah, God forbid we throw another pandemic into the mix or something, then Lord knows what what we could be looking at. But I think that's a good thing to remind people, and I think that's what my logic was kind of telling me. It's like, well, you wouldn't necessarily have to refinance because if rates are lower, then your adjustable rate will probably be adjusting down in that scenario, and you just hang on. You don't sell.
Absolutely.
All
and
right,
another good segue. I don't know if you're doing this on purpose, but that's another good segue into the next slide.
All right, let's do it.
So this plays perfectly to what we were just talking about, guys. Diversification. So big on my list of useful advice for any new client that I talk to, whether they're brand new to real estate investing or they're super seasoned, is diversification. And when you say that, a lot of people just assume that means that not putting all your eggs in one basket, not just doing one particular market. Diversification in my mind means the type of property, the term, right? Interest only, maybe a fixed, maybe an ARM, maybe a first lien HELOC, if it makes most sense for the property. Obviously diversifying in the different markets. And let me go back to type really quickly. So type, single family to 2 to 4, obviously, but also a short-term rental versus a long-term rental. You want to have a good balance of both of those things. And I will just quickly mention, since it's coming up a lot more lately, if you haven't got into short-term rentals yet, I would encourage you to make sure that in the market that you're most interested in, check the township, check the municipality. There are certain areas around the country that are drawing lines in the sand about short-term rentals in different areas. There are counties in Hawaii right now that are saying, nope, no short-term rentals here. And if you buy a property thinking that you're going to use it for a short-term rental, but then you're not allowed to, that's a problem. So do your homework where that's concerned. So again, 2 to 4 units, single family residence, short-term, long-term. I'm going to take another second to talk about short-term. For those that haven't considered this, a lot of times short-term comes with the idea that it's for a vacation rental. There's lots of professionals, I'll just use the traveling nurses, that's a common one, where they need a crash pad for a week or 2 weeks when they're on assignment in these different places. And I'm finding a lot of my investors actually prefer that because the wear and tear on the property tends to be a lot less when they're using a short-term rental for a traveling professional that's just really there to sleep and then they're working on assignment or whatever, versus you've got a family coming and staying for, you know, a week or 2 weeks. Anyway, and then finally on this list, we've got our appreciation versus cash flow. You know, a lot of times, and I think it needs to cash flow. By what amount? I could argue several different ways. As long as you've got the tenant making the mortgage payment for you, I think I said this earlier on, I think it's a good investment, but don't discount appreciation. A lot of my clients, at least as they're getting started, they come to me and say, we're not interested in appreciation, we only want cash flow. Okay, maybe what we do then in that case is we look at your overall portfolio and we say 80% of it is really going to be focused on the highest cash flow areas. Wonderful. Do not discount appreciation. That is extremely short-sighted, and you will end up losing big if you give no consideration to appreciation, because a lot of wealth can be built in appreciating markets. So balancing act, right? We really want to balance out our portfolio so that we have the best of all the different variables that real estate produces or provides for us.
Yep, I love it. And I think that's why, you know, we've always kind of offered a spectrum of market types. You know, we're fundamental. So we like you think that everything should have, you know, should cover all of your costs, but we do kind of have a spectrum. You know, some markets are generally a little bit flatter and offer that higher cash on cash return. Others, that cash on cash return is much more moderate, but you maybe have more likelihood of some appreciation. And so if you haven't engaged with an investment counselor at Real Wealth to kind of talk through the spectrum of market types that we offer and that we're seeing opportunities in, then definitely hop on a call with your investment counselor to talk through some of the different market profiles that we have connections in.
Yeah, that's so true. I think Real Wealth has always done such a good job of being in those deferring markets for all of those reasons more often than not. And I don't know, Lee, if you find this to be true. And keep in mind, you guys, there's always going to be exceptions. Why? I don't know that I need to be on off camera anymore. There's always exceptions to every rule. But I think that more often than not, we're going to find that the Sunbelt states are going to be the ones that give us the highest appreciation. And then the landlocked states generally are going to have the higher cash flow. What you may want to consider, I'm seeing more and more of this, and they're a little harder to find, but a 2 to 4 unit property in a more appreciating area where you could use 2 of the units for long-term renters and maybe 2 of the units for short-term rental. You've kind of killed a few birds with one stone. That seems to be something that investors are starting to connect the dots on. So anyway,
Yeah.
I'll get off that tangent.
Yeah. Okay, so if we have you here and you're seeing more deals than most of us do in a lifetime, probably in just a work week. So we didn't ask some predictions about where you think things are headed.
Yes. I think that rates are going up, and I think we're going to continue to see them go up, but so what? I think for reasons that I've already laid out here today, you need to be looking at the investment and looking at it historically. You need to be looking at currently. You need to be looking at it futuristically. Holistically look at the numbers and look at the big picture. Do not focus on the rate. Remember the variables that we already spoke about. interest rate for me is somewhere buried in number 10 or 11 of all the different characteristics and variables that I'm considering when I'm going to refinance or buy an investment property. Rates are going to go up. Okay, you can count on at least for the interim until the Feds stamp out or really do a good job of stamping out some of these inflationary numbers. Inventory availability is going to also continue to go up. I believe rates values are going to come down. It's going to give us supply and demand. Okay, interest rates are up for the homeowner that probably can't qualify. That's going to also create more inventory for us. That's a good thing. As a seasoned real estate investor, I encourage you to be ready for that because it's here. We're there. And then home values, like I just said, I think they're going to come down a little bit. I do not think that the sky is falling, and I do not think that we're going to have, in my case, pre-0809, a $1.2 million property that I couldn't short sell for 500 grand. That's not going to happen. But I do think that it's going to be more manageable and appreciation levels are going to come back down and be more sustainable. This is all good stuff for us.
Yep. All right. How can people get in touch with you, Caeli?
Look at all that. You can call us toll free. 855-74-RIDGE is an easy way to remember there. Our website, ridgelendinggroup.com. You can email us, info@ridgelendinggroup.com. We'll be on standby for answering questions, running scenarios. We should be a wealth of information for anything that you guys need to run past us.
Yeah, and Caeli, you guys have started recently a new community group. Tell me about that.
Thanks, Leah. Thank you for reminding me. Yeah, so it's pretty cool. Anybody is welcome to join. We do weekly live events where either myself or Larry Bailey, who's kind of my partner in crime and handling some of those, will take topics that are high priority given the environment of wherever we are. We talk about underwriting guidelines. We take beta test clients through simulation of qualifying and their power buying, right? What can they really qualify for based on their qualifications today and their goals? It's pretty cool. So the weekly live events are Tuesday. I want to say they're at 4:30 Eastern, 1:30 Pacific. But there's a lot of good content on the community page, and there's forums for people to talk in between themselves. It's pretty neat.
Yeah, good. Yeah, I've enjoyed watching them. Caeli, set our expectations for like the assistance that you guys offer. You talked about do the math, and I know as one of your clients, you have in your team have assisted me in analyzing the math of some of my properties by providing some, cost sheets or some fee sheets to look at exactly what we could pull out, exactly what the rates would change to. But set our expectations for this group. I mean, how does somebody get access to that type of assistance that you guys provide, and what is kind of the how do you get into that funnel?
Yeah. So the first things, gang, is just to apply, right? Go to our website. You can apply right there. Once we get your application in, we're going to collect your documentation, depending on what your goals are, vials of blood and DNA samples. That's an oldie but a goodie. But once we have all of that and we have that baseline of information, then we get back on the phone with our clients and we really understand what their goals are, short-term and long-term. We start to layer in the education as it applies to their qualifications and teaching them how to optimize those things. Because let's face it, most investors are not going to just do that one transaction. They're going to buy and sell and refi and all of these things. So they need to understand how their qualifications are going to evolve and change, how to keep them at their best so that they are securing the best rates and terms. So that's just freebie stuff that we give to our clients. It's the value add that we have. Once they're our clients and they've applied, they get all of that stuff as just part of being part of the Ridge community.
Right. So you do the heavy lift of giving you all the paperwork, but then that gives you access to the quality team that Caeli has and the type of analysis that they kind of can help you see, can kind of bring to light. I know there were several instances, Caeli, where your team would look at you and you personally would look at some of our options and go, I just don't think a cash out refinance is really, the juice isn't worth the squeeze at this point based on the transacting cost to just access that capital. Let's hold off for a couple years. And coincidentally, interest rates went as low as they did, and you're like, okay, now is a great time to do it.
Yeah. So we're so not interested in a one-off commission, right? We really want to build that relationship and focus on educating our clients and giving them our fair assessment, whatever that means.
Yeah. Awesome. All right. I think our next slide is questions. So actually, I'm just going to leave up your contact info while we work through some of these questions. I want to kick it off with a question that I promised our viewers last week. We did a vacation rental or short-term rental webinar with our Jacksonville property team. And the question was asked there, and we're qualified enough to answer it, but the question was asked, how does a lender look at your debt to income ratio with a short-term rental purchase? If you have never done a short-term rental, are you looking at the long-term rental rate to offset the debt of that asset, or can you look at the projected nightly rates to offset the debt?
It's such a good question. And for almost without exception, right now in the acquisition year, which means from the day that you purchase it and until that property falls on a tax return, okay, so depending on when in the year you purchase it and when you file a tax return, we're going to be using the long-term rents via the appraisal, okay? On a short-term rental, it's not going to be leased before you close, and it's certainly not going to get a long-term lease after you close, but underwriting guidelines are not currently allowing for what the short-term income is until it falls on that Schedule E, which is where the properties will live, right, once the tax return is filed. So what we're going to do, it doesn't need to be leased in order to give the individual a percentage of the rental income. We will use the appraisal. An appraisal on any rental property, short-term or long-term, is going to come with an additional form. It's called a 1007. It's just the number on the page, okay, the 1007. The 1007 is going to have rental income comps, long-term rental income comps of 3 or 4, like-kind properties within the general area. So the appraiser is going to take the gross rents for each of these tenant-occupied homes. This is public record. He's going to add them all together and divide by the number of comps that he chose. Whatever that number is what we're going to give up to, remember, up to 75% to offset the new mortgage payment. So we're finding that unless the property is, $1 million+, more often than not, that number will at least offset the new mortgage payment. So it should be just fine. After you own the property, okay, that's an acquisition. As you're purchasing it before you officially own it. After you own the property, you're not going to get any rental income to offset that. So if your debt to income ratio is tight by hitting you for the full payment, I would suggest using or buying that one maybe closer to the end of the year until, right? So depending on what you want to do in the year, and that'll be a strategy conversation that you'd have with us.
Right, right. I love that. That my mind with the same exact thing is like, okay, you would probably want to do it towards the end of the year, or make sure that you don't have any other closings happening immediately after closing on that one that would cause problems.
Right, close them SIMO. Yeah.
Yep. All right, thanks for answering that one for us. Okay, we've got a lot coming in here, so we'll start working our way through some of these. Caeli, do you have a couple extra minutes? I know we're over the hour.
Absolutely.
Okay. Let's see. Did I hear Caeli right that you are not licensed in New York?
That is correct.
Womp womp.
Womp
Any
womp.
recommendations in New York? I don't know that you would. We
used to. I don't know. They're no longer in New York either. New York is one of those states, and compliance state licensing, guys, is tough just because it's the nature of regulation, whatever. But but New York, forget about it. It's very difficult to maintain licensing there. So I'm sorry, I don't have a good referral for you. Normally I would, but I don't.
Okay. Do you work with LLCs?
Absolutely. Most of our products you can close in an LLC name at closing. The exception would be Fannie Freddie. You've got to close in your individual name. However, there's some bad information, old information out there that says a lot of people assume after you close that if to execute a quit claim deed, QUIT claim deed into your LLC afterwards is a problem. Fannie Freddie does not care about that anymore. As long as you have the majority ownership in the LLC, you can quit claim right after closing from your name into the LLC entity.
Great. Nice that has gotten so clearly black and white. When I started, it wasn't so.
Right.
All right. Do you offer lending options for non-USA residents for single family? And if so, what are the options and interest rates?
So I think, are you talking about a foreign national? If that's the answer, yes. We have foreign national.
I'm going to assume, yeah.
Yeah, we have foreign national products. If depending on whether the individual has a credit score, a U.S. credit score or not, is going to change the interest rate. But I would say you're probably going to be, I'm guessing, I don't have all the variables. You're probably going to be somewhere in the sevens. 70, 75% leverage.
Right. And to give everybody context, I mean, assuming like optimum borrower credentials, like what are you seeing 30-year fixed rates with 25% down today? In what ballpark?
Conventional Fannie Freddie,
Yeah.
you're going to be 6.5.
Okay. That's good. I had a call with an international buyer this morning and he thought 6 was really high. And I was like, well, I don't know. In today's context, that's kind of the best
So
thing
much.
going.
Yeah. And I just want to put highlight something there. Largely dependent on the loan size, everybody. A $500,000 loan size is going to carry a much different example than I'm about to give you. But on 100 grand, the difference between 5.5 and 6.5 is probably less than $50 a month.
Yeah.
So please, I know I sound like an idiot and a broken record here. Do the math, okay?
Mm-hmm.
Get out of the psychology of just hearing one thing and assuming that it means X. Actually do the math. I think that you'll be surprised.
Right. And to your earlier point, if $50 is the make or break, you're probably investing in the wrong thing. You probably shouldn't be buying real estate if that's the that's the deal breaker.
Agreed.
Okay, David says earlier in the presentation you mentioned turnkey partners. What's a turnkey partner? David, you're in the right place. A turnkey partner is one of the referral partners that we work with who provides you a turnkey investment product, fully rehabbed or brand new. And there's a seamless kind of handover to professional property management. We've got 15 different turnkey partners across the nation. So connect with your investment counselor to get some coaching on which one of those partners might be best suited for you.
And the nice thing, I'll just dovetail on that, Leah. The nice thing about Real Wealth and having those relationships is one, they've been well forged for many, many years, and Real Wealth can throw some weight around, okay? But they've already done all of the vetting, right? They know what they're looking for in terms of the industry and the property management, all these different things. They've already done all that work for you and hand selected the different turnkeys. And so Ridge is the preferred lender for, I don't know, 12 dozen different groups all over the country. Real Wealth stands out as someone that is true to what our philosophies are in the education that they provide for their investors, and they take it a step further because I think Kathy does such a good job in vetting the different markets and staying in the front lines of where the next to the next best big market, good market for their investors is going to be. So you could not do better than the turnkeys that Real Wealth promotes.
I appreciate that, Caeli. Okay, Rory asks, if we enter stagflation period now, as we did in the 1970s, which I remember very well, the Fed will raise interest rates even if it takes years in the face of a recession to try to reduce inflation. Mortgage rates were about 15% and I got 12% paid in my savings account. Stagflation is a very possible outcome now.
I'm not familiar with stagflation. I might have to Google search that myself. What I would say is that even if we find ourselves in that space, what happens to everything else? Are you saying that stagflation means that everything just skyrockets in rates and cost of everything goes up, but
there's a recession, wages are down, and economy is low?
I would like to have an off-book conversation with you about that. Let me get some more information about it, and we can talk about it one-on-one. I don't know that I agree or disagree with you yet, but let me do my own due diligence on what do you call it? Stagnation?
Stagflation. Yeah. Okay. Fair. All right. Jack wants to get clarification about your thought on the annual rent increases. So if you could summarize that connection that you were trying to make with raising your rent every year.
So first you want to check with your property manager. And if you don't have a property manager, I would say that the most modest amount of annual appreciation for rents should be 2%, right? 3% on a modicum, very, very low in terms of what it probably realistically is. I don't know if I'm answering your question, but you should be appreciating your rents similar to, typical appreciation in a property. The rents you should be charging should be going up at least at a very, slow burning tick.
Right. And the correlation of like the cost to produce goods does dictate the cost that you sell the goods at to some extent. So same is true in real estate. The cost to hold the asset is higher at higher interest rates. That usually translates to higher costs that you can ask in rent. So making sure that I think you keep yourself kind of in lockstep with what the rest of the market is doing is important, so that you're not subsidizing someone else's living expenses.
Absolutely. And that's not what real estate is about either. So I doubt that you'll see that.
Yep.
I want to go back to the stagflation thing. So continued inflation, and I did just do a dear Google here, but it assumes too that the unemployment rate is at an all-time high as well, right? You know what? Put a pin in it. Call me, email me. Let's have a conversation.
Yeah. Okay, Joe says investor ARM rates are higher than fixed rates at this time. I don't think that's true, Caeli, right? And that kind of what you were saying, the ARM rates are lower than the fixed rate.
Just changing. Just literally, Joe, I mean, just today, yesterday, last week, it's really just on the verge of making that change so that the ARMs are going to price lower than a 30-year fixed.
Right, right. So the news headline is record high ARM mortgage applications. And you should be scared because these are scary and volatile. But the truth behind the headline is that for the first time, this inverted yield is occurring, and it is financially more advantageous for people underwriting their deals to use an ARM versus the long-term fixed.
For the first time in a long time, inverted yield is flipping back to the way it's supposed to be. Yes, exactly right.
Great. So consider the ARM. If you haven't at least looked at it, do the math, right?
Do the math.
Okay. David asks a question here. He took advantage of an extended rate lock program offered by a lender. Unfortunately, now the builder is saying they won't close in time. So the question is, can I try to extend further? Should I try to change to an ARM or interest-only loan? What do you think, Caeli?
Yes, maybe. Maybe is my answer. I need to know what, it was David, right? David, call me. Mm-hmm. I need a lot more information before I can give you my 1.3 cents worth, sir.
Yep. That's starting to become a familiar conversation because we're 6 months from when one of our lenders, kind of initially launched that program. And if builders are facing delays, you bought into that program, so there might be a loss there, but the loss could be worth taking if you can make up for the savings with one of these alternative loan products. I would check it out. Okay. What do you think, Caeli, about investing in slow appreciating markets like Baltimore or Cleveland?
As long as you're offsetting with some other markets that have appreciation and the cash flow is sufficient enough, absolutely. Diversify your portfolio with high cash flow, some high appreciation, long-term, short-term. I would just make it a nice, based on your individual qualifications and your goals. The percentages of the diversification is going to be unique to you, but I guess a general rule of thumb, if I'm going to give one, I usually say, single family residents, 70-80% of their portfolio, 2 to 4, 20-30%, long-term, similarly, 70-80%, short-term, right? I kind of would balance it out that way for someone that's just kind of more risk averse. That's a more conservative way to look at it, but by all means, yeah, as long as the cash flow is there, that should be part of your portfolio, and then a few properties over here that have a higher appreciation access.
Right, that's what I do. Okay, there's a couple requests here, Caeli, for like specific rate quotes. People wanting to know general ballpark for ARM, general ballpark for the DSCR rates. I don't know the best way to answer that question with value, so maybe I'll let you.
I would say that it's going to be very subjective to the characteristics of the transaction itself. So things like loan size, loan to value, credit score, property type, debt service versus ARM, all of those variables are going to attach its own unique adjustment to rate. I can give you guys averages. Otherwise, I'd have you call in or email and we can get you an actual example quote. Debt service ratio, probably high 6s, mid 7s, maybe higher, depending on some of the variables. An ARM, I think we're going to find them in the lower 6 range. 30-year fixed, mid 6 or higher on a conventional loan, but very, very subjective to the characteristics of the loan itself will dictate what rate you lock at. And you guys, that's today. At what time is it? 1:24 p.m. Pacific time. Ask me again tomorrow and the day after, because
Right. Have you
Anybody's
guys already seen a spike after last month or
after the
not
Fed's
yet?
raised?
Yeah.
No, actually, we saw them come down. So this is, I'm glad you brought that up. So, a lot of people mistakenly attach or assume that the Fed fund rate is exactly the same as the 30-year fixed rates that we get for mortgages, when they absolutely are not. There's a connection, but they're completely separate. The Fed fund rate is the daily trading rate between banks, right? What they're going to trade on between each other. What happened last week when we saw the 0.75% increase to the Fed fund rate was that Wall Street has a funny way of taking the posture or the language of the Fed and translating it into how it's going to change the stock markets or the bond market. When that happened, it was a signal or a message to everybody saying that the Fed is going to stay true to their word and they're going to stamp out inflation at any cost. So it actually did the reverse. The bond market improved and we saw rates come back down a little bit.
Interesting.
Yeah.
All right. Well, Caeli, I want to be mindful of your time. We're coming up a half hour over the hour. So I think we'll leave it there. But Caeli, we are so appreciative for your expertise. Again, to reiterate, like, you can connect with Caeli and her team and have access to all of this knowledge and experience by working with them. So definitely don't hesitate to reach out. Caeli, do you have any final closing remarks or encouragement for our viewers?
Don't sit on the sidelines, guys. Check out your portfolio, do the math, see if it makes sense. We're here on standby if you need anything. Thank you, Leah, for having me.
Yeah, you're welcome. Thanks so much for joining us, Caeli. And thanks to all of you guys who stuck around over the hour. We'll post this replay on the investor portal by tomorrow afternoon. You'll find it under Ridge Lending Group's page. All right.
Thanks,
Take
guys.
care, guys.
See ya.
See ya.